Yeah, very good afternoon to all. I am Professor Anuradha Jain, Professor of Economics at Vivekananda Institute of Professional Studies. Today we are going to discuss about balance of payment. As you know that all countries are dependent upon each other in terms of trade, export, import or other capital transfers. So keeping the records of all these transactions between one country and the other country is very important. So balance of payment is all about how we maintain this balance, how we maintain these records. So in this session we are going to discuss about what balance of payment is all about, what are the components of balance of payment and how it is kept in balance, or what are the situation of the balance of payment, in which situation it is deficit, surplus or balanced. So this all topic we are going to cover in this session. So a country has to deal with other countries in respect of many activities, like for example in terms of visible items, which includes all type of physical goods exported and imported. Invisible items, which includes all those services whose exports and imports are not visible. For example, transport services, medical services, insurance services, banking services and all. Another is capital transfer, which are concerned with capital receipts and capital payments, like taking loan from other countries, repaying of loan, paying interest on the loan taken. Foreign direct investment, it also covers other type of grant, aid, help, which goes from one country to the other country. So all the records of all these items comes under the balance of payment. And according to Kindleberger, the balance of payment of a country is a systematic record of all economic transactions between the residents of the reporting country and the residents of the foreign countries during a given period of time. And in this, normally a given period of time is 1 year. It is a double entry system of record of all economic transactions between the residents of a country and the rest of the world carried out in a year or in a specific period of time. Now, when we say a country's balance of payment, we are referring to the transactions of its citizens and the government. So, the balance of payment of a country is a systematic record of all economic transactions between the residents of a country and the rest of the world. It presents a classified record of all receipts on account of goods exported, services rendered, and capital received by residents and payments made by them on account of goods imported and services received from the capital transferred to non-resident or the foreigners. Now, what are the features of balance of payment and how it has characteristics of the balance of payment? So, first is that it is a systematic record of all economic transaction between one country and the rest of the world. Second is it includes all transactions, visible as well as invisible. Visible means all goods and services, import and exports of goods and services. Invisible means only services there, those who are not visible, but the payment for the services or receipt for the services takes place. It relates to a period of time and generally it is 1 year, or you can say annual statement, which is placed. It adopts a double entry bookkeeping system. It has two sides, like credit side and debit side. Receipts are recorded on the credit side and payments on the debit side. Another term which is related to or is a part of balance of payment is balance of trade. Now, what is balance of trade? It is a difference between countries' imports and its exports. Balance of trade is the largest component of a country's balance of payment. Debit items like includes imports, foreign aid, domestic spending abroad and domestic investment abroad. On the other hand, credit items include like exports, foreign spending in domestic economy and foreign investment in the domestic economy. Now, when exports are greater than imports, then balance of trade is favorable. and if imports are greater than exports, then it is considered to be unfavorable balance of payment, because we have to make more payments against the receipts that we are getting against the exports that our country is making. The balance of payment takes into account all the transactions with the rest of the world. On the other hand, the balance of trade takes into account all the trade transactions with the rest of the world. So we can say that balance of trade is subset of the balance of payment. Now, if you distinguish between the two, balance of payment and balance of trade, then with the definition it is clear that balance of payment is a broad term and balance of trade is the subset of the balance of payment. Balance of payment includes all transactions, related to visible, invisible items and also the capital transfers, whereas balance of trade includes only visible items. So only the trade of goods are included here in the balance of trade. Balance of payment is always balances itself. Okay, but balance of trade can be favorable or can be unfavorable. That means balance of trade can be in surplus or can be in deficit. So it is in surplus when your exports are more than imports. That means when your receipts are more than the payments, and unfavorable when your payments are more than the receipts, or you can say that when your imports are more than the exports, because when you are doing imports, that means you are making payment against the goods imported from the other country. Now if we define balance of payment, then balance of payment is equal to current account plus capital account or plus any balancing item, that is error and omission that takes place. And balance of trade is only net earning on exports minus net payment on the imports. So these were the major differences between balance of payment and balance of trade. Another difference is that balance of payment are the main factors which affect balance of payment. The main factors are like conditions of foreign lenders, economic policy of the government, and all the factors of balance of trade. So that all affects the balance of payment, like it will be in surplus or it will be in deficit. But on the other hand, if we talk about balance of trade, then the main factors which affect balance of trade are like cost of production, availability of raw material, exchange rate, prices of goods manufactured at home. Now for example, if I take one example of cost of production. Now if cost of production in our country is more as comparative to the cost of production of the same product in the other country, then obviously people will prefer to import those goods. Why? Because the price of imported products will be lesser than the price of the product which are produced in the domestic economy. Okay, so that will affect your balance of trade. Similarly, prices of goods manufactured at home. So if prices are more here, then obviously imports will be more and your balance of trade will not be in favor. So exchange rate also affects import and export of the commodities, so that will again affect the balance of trade. So these are the main factors which affects the balance of trade and balance of payment. Now next point that comes is like why we need to know about balance of payment, or why balance of payment is very, very important for any economy, or what are the importance of balance of payment. So first is that balance of payment records all the transactions that create demand for and supply of a currency. Another importance is that judge economic and financial status of a country in the short run. Another important importance of balance of payment is that balance of payment may confirm trend in economy's international trade and exchange rate of the currency, and this may also indicate change or reversal in the trend, because if balance of payment is in surplus, it means that the demand for your currency is there in the market, because your exports are more, your demand for your products are more. It means that you are exporting more, you are earning more revenue, and if more revenue means the demand for your currency is increasing, so that will give you the trend of economy's international trade and also the exchange rate of the currency. Then balance of payment may indicate the policy shift of the monetary authority of the country, like what will be the policy. Okay, what changes can this RBI or fiscal policy can bring in depending upon the economic situation of the country, depending upon the exchange rate of our currency in the economy. Balance of payment may confirm, trend in economy's international trade and exchange rate of the currency, and this also indicate or change or reversal in the trend. Then balance of payment accounting serves a very useful purpose, as it yields necessary information on the strength and weakness of a country in international economic transactions. Another importance or purpose of balance of payment is that by analyzing the balance of payment accounts of past years, one can find the overall gains and losses from the international economic transactions. It can be ascertained whether composition and direction of international trade and capital movements have improved or caused deterioration in the economic condition of the country. And like suppose if balance of payment is in deficit or current account deficit is there, so it's a matter of worry for any economy, because it means that your payments are more, your revenues are less, and you will have loss of your foreign reserves that will affect your currency in the international market, your exchange rate in the market. So that means the analysis of balance of payment accounts gives the overall economic status of the country in the international economy. Then balance of payment statements give warning signals for future policy formulation. Now, if balance of payment shows persistent large deficits over a period of time, it means a persistent growth in international indebtedness. Why? Because if it is deficit, it means that you have to have more payments, and if there are more payments, it means that you may have to take loan from the other countries to repay that loan, or your foreign reserves are decreasing. So high BOP deficit may cause financial bankruptcy, and this has happened in India, and we faced this situation in 1991 when new economic policy was introduced. A regular review of balance of payment provides guidance for formulating appropriate foreign trade and exchange rate policies. So these were the main importance of balance of payment, and you must have seen that it's a very important concept, and every country should know the status of the balance of payment, and accordingly they should formulate their policies for future. Now, what are the determinants of balance of payment? There are several variables which determine the balance of payment position of a country, like national income at home and also abroad, exchange rate of our currency, the prices of goods and services, international oil and commodity prices, because it's a comparative analysis. Whatever price prevail in the international market, your export and import will also depend upon that. So it's a comparison between your own prices of these products and the prices of the commodities in international market. Supply of money also is the main determinant, because that affects the purchasing power of the people. That also affects the demand for the commodity in the market. If supply of money is more, purchasing power will be more, and people can afford to buy more commodities, and in that case also there are chances of increasing imports, or maybe it will also decrease the exports, because all goods produced in the economy will be consumed by the people itself, and therefore that may affect the exports also. Then rate of interest also is a main determinant, because that will affect the capital movement, capital transfer from one country to the other country. Now, all of which determine exports, imports, demand and supply of foreign currency, you can say, are the determinants of balance of payment. Now at the back of these variables lie the supply factors, production function, the state of technology, taste, distribution of income, economic conditions, the state of expectations, etc. Because all these factors will also affect your balance of payment. Suppose for example, if we talk about any example of like state of technology in the economy. Now if the economy is technologically advanced, in that case the cost of production of the product will be less because production can be done at large scale. Okay, so if cost of production is affected because of the state of technology, it means that it is going to affect your imports and exports. So all these variables are very, very important, like production function, state of technology, taste, distribution of income, etc. Now if there is a change in any of these variables and there are no appropriate change in other variables, then there will be disequilibrium in the balance of payment. Okay, so how the disequilibrium is created, what are the different methods to correct this disequilibrium in the balance of payment, we will be discussing in detail. But before that, let us understand what are the various components of a balance of payment statement. Now the important components of a balance of payment statement is, one is the current account, another capital account, reserve account, error and omissions. Now let us discuss this one by one in detail. Current account balance first. Now balance of payment on current account is a statement of actual receipts and payments in short period. Now it includes the value of exports and imports of both visible and invisible items, and there can be either surplus or deficit in current account. So the current account, in other words, includes exports and imports of goods and services, interest, profit, dividend, unilateral receipts, payments from and to abroad. Now balance of payment on current account refers to the inclusion of three balances of, namely like merchandise balance, service balance and unilateral transfer balance. Balance of payment is more comprehensive in scope than balance of trade that we have already discussed, and it includes not only imports and exports of goods which are visible item, but also such invisible items as like shipping, banking, insurance, tourism, interest on investment, gifts, etc. Now country like suppose India has to make payment to the other countries not only for its imports of merchandise but also for banking, insurance and shipping services rendered by other countries, and it has to pay further the royalties for foreign firms, expenditure of Indians in foreign countries, interest on foreign investment in India or on loans obtained by India from other countries, and such international organization as like IMF, IBRD, etc. Now there are debit items like for India, since these transactions involve payment abroad. Now in the same way, foreign countries import goods from India, make use of Indian firms and so on, and for all of which they make payments to India. Now these are the credit items for India as later receives payments. So balance of payment thus gives a comprehensive picture of such transactions, including imports and exports of goods and services. Now what are the types of balances that can happen in the current account? One is the trade balance, that is merchandise exports minus imports of goods, services. Okay, export, imports of services. Then income balance, that is net investment income, net income receipts from assets, net international compensation to employees or net compensation of any employee. Now net unilateral transfer means gift from foreign countries minus gift to the foreigners. So that was about current account. Now what is capital account? Capital account balance means the capital account records all international transactions that involve a resident of a country concerned changing either his assets with or his liabilities to a resident of another country. Now transactions in the capital account reflects a change in a stock or either assets or liabilities. Now it is a difference between the receipts and payments on account of capital account, and it refers to all financial transactions mainly. So the capital account involves inflows and outflows relating to investment, short-term borrowings, lending, and medium-term to long-term borrowings and lending. Now there can also be surplus or deficit in capital account, and capital account includes private foreign loan flow, movement in banking, capital, official capital transaction, reserves, gold movement, etc. And these are classified into two categories: direct foreign investment, portfolio investment, or any other capital. Now in the balance of payments on capital account has two important items. One is borrowing from foreign countries and the other is lending to the other countries. Now this takes two forms. First, external assistance, which means borrowing from foreign countries under concessional rate of interest, and second is commercial borrowing, under which the Indian government and the private sector borrow funds from the world money market at higher market rate of interest. Now besides non-resident deposits are another important item in capital account, and these are the deposits made by non-resident Indians, that is NRI, who keep their surplus funds with Indian banks. Another important item in balance of payments on capital account is foreign investment by foreign companies in India. And there are two types of foreign investment. First is portfolio investment, under which foreign institutional investors, that is FII, purchase shares and bonds of Indian companies and the government. The second is foreign direct investment, under which foreign companies set up plants and factories on their own in collaboration with the Indian companies. Now still, another item in capital account is other capital flows, in which the important source of fund is remittances from abroad, sent by the Indian citizens working in the foreign country. So capital inflows in the capital account can be classified into debt creating and non-debt creating. So foreign investment, both direct and portfolio, represents not debt creating capital inputs, because they are not giving any debt. In fact, they are investing their money in the country. Now whereas external assistance like concessional loans taken from abroad or external commercial borrowing and non-resident deposits are debt creating capital inflows, because we are taking loan from them which we are supposed to repay after the period for which that loan has been given. So capital flows are driven by pull factors such as economic fundamentals of recipient countries and push factors such as policy stance of source countries. The capital flows have implication for like exchange rate management, overall macroeconomic and financial stability, including liquidity conditions. Capital account management therefore needs to emphasize promoting foreign direct investment and reducing dependence on volatile portfolio capital. And this would ensure that to the extent current account deficit is bridged through capital surplus, it would be better if it is done through stable and growth enhancing foreign direct investment flows. Now in the present international financial situations, reserves are the first line of defense against the volatile capital flows. However, the deadline in reserves as a percentage of GDP is a source of concern there. Then next is the reserve account, and three accounts like IMF, SDR, reserve and monetary gold are collectively called as the reserve account. The IMF account contains like purchases and repurchases from International Monetary Fund. SDR are the reserve assets created by IMF and allocated from time to member countries. It can be used to settle international payments between monetary authorities of two different countries. Another account is errors and omission. So the entries under this head relate mainly to leads and lags, in reporting of transactions. It is of the balancing entry and is needed to offset the overstated or understated components. So this is the example of how receipts and payments are taken into account, like exports of good on the credit side, then exports of services, so and so forth. So this is the how the accounts balance of payment is maintained, and how the current account entries are done, and how capital account balances are maintained, and total then is known as the balance of payment. Okay, so this was about the basics about what balance of payment is all about, what are the importance of balance of payment, and also what are the components of balance of payment. So thank you so much for this session, and we will be meeting again for more detail about balance of payment. Thank you.